Craig Sullivan with Sullivan Financial Partners. Welcome back to the Confident Retirement Journey. Today we're going to talk about taxes. In fact, we're going to talk about how the IRS taxes your retirement income. Pensions first. Typically, any pensions you have are going to be taxed as ordinary income. Now, there can be some caveats to this if you contributed after-tax dollars, but for the overwhelming majority of people that we see, their pensions are going to be taxed at ordinary income rates. A lot of time people think, well, I'm not making as much in retirement, so my tax rate should be lower. I would actually tell you that we should question that for multiple reasons. Number one, we see where tax rates are headed. And number two, most of the people we work with don't think that they want to take a step back in their lifestyle in retirement. On the other hand, they choose to step forward and go do a lot of the things that they wanted to do to begin with and never were able to accomplish during their working years. Sales of stocks, bonds, and mutual funds, on the other hand, can be taxed most often as capital gains. If it's long-term gains, they can be taxed at 0, 15, or 20% depending on your overall tax brackets. Making sure you understand the differences can have a pretty good effect on your overall plan. Now let's talk about dividends. Right? There are some qualified dividends that can be taxed at long-term capital gains rates, where non-qualified dividends are taxed as ordinary income, thereby raising your potential tax liability. Retirement accounts. Most of your 401ks, your IRAs, your 403bs, your TSP accounts, etc., those are going to be taxed at ordinary income as well. Whereas you have the required distributions starting at age 73. If you have money in Roth accounts, Roth IRAs, Roth 401ks, these dollars you paid tax on as you contributed them to the account. You did not take a tax deduction. So now when you take that money out and all of its growth, you're able to take that out tax-free. Now, if we take out withdrawals prior to 59.5, we are subject to some penalties. So you still got to follow some specific rules. The whole point is this. When you're building your income plan and you're trying to decide where should I draw money from in any given scenario, having a plan is important. Get some help if you don't have that ironed out. If you don't truly have a full income plan in place to know these are the accounts we're taking money from at what time, or if we've considered should we take money and move it to a Roth right now? Should we look at a tax conversion strategy as well? You probably need to find somebody to chat with. As part of our Confident Retirement Journey, this is one of the areas that we specialize. We want to make sure not only that you have an income plan, but that it's a tax-efficient income plan. If that's something that you need help with, give us a shout. We'd love to visit. Thanks. Take care.